Hello my fellow freedom builders and welcome back to the channel. Today's video has a bit of a educational character. We're going to have a look at inflation, what it means to interest rates and why it is important to know the real inflation rate when you are investing. Now first of all, the reason why I am making this video today is that tomorrow we are going to have inflation numbers from United States. This is quite important, and it means that the days up to these inflation numbers come out, the market is often a bit strange because people are not really sure what to expect. Now the inflation part is quite simple actually. It means that if the inflation rate over the last year is 5%, that if you have bought something for $100 last year, it is now costing $105. That is at least the simple terms. It's a bit more complex than that, but it gets a bit more messy because we have what is called the core inflation rate, and that is what the central bank in the United States are looking at, partially anyway. We also have what I'm calling the normal inflation rate. The normal inflation rate is basically just all the goods and services you can buy put into one basket, and as you can see, last month that year or that number year over year was 4%, and now it is forecasted to drop to 3.1%. That is great. We want this number to be around 2. However, the core inflation rate, which is what Fed looks at the most, is dropping from 5.3 to 5%. The difference between these two is that core inflation is not including food and fuel. And you might think to yourself, why would they exclude that? If the inflation numbers should somehow mirror the day-to-day expenses of a normal consumer, then why would they exclude that? And that is a very good question I have asked myself many times. There are some fancy explanations, but basically what I am looking at personally is the normal inflation rate. If we have a look at that, this is on the daily FX, but you can find this number many places. You can see that in June last year that was 9.1%. and now it is only 4. So it is definitely going in the right direction. We don't want too much inflation in society because that simply makes the economy really weak. However, we don't want it to be too low as well. If this goes into negative, for instance, we have what is called deflation. And deflation means prices are going down year over year. And you might think to yourself, that sounds really nice, prices going down, but we don't want deflation as well. Because if I could buy a car at $50,000 this year, I might wait a year because I know that in a year I might only have to pay $48,000 or $47,000 for it. And that means that if all the consumers are postponing the purchasing of durable goods, then a lot of the economy is going into a halt and people are getting fired and we are seeing some recessionary movements. So basically, we're going to have a look at inflation today. And as I said, you can find this many places. You can also find it in the trading economics here. But why it is important is that the higher the inflation is right now, the more that urges Fed, the central bank in the United States, to hike the interest rates. You probably know by now that they have been hiking the interest rates quite a lot. And if we look at and listen to the different Fed chair speeches here, Fed Kashkari is speaking tomorrow, but they are out speaking all the time. What they're communicating is basically that the interest rate is going up 2 times more this year, with 25 basis point every time, meaning 0.25%. We can look at a website called, you can search for it, it's called FOMC Countdown. And that is with the CME group. You can see there's 15 days and 6 hours to the next FOMC meeting where they are telling us what they are planning for the interest rate. Right now, the market is pricing in around 95% probability of one rate hike next time. They are simply doing this to put a bit of a brake or a bit of a hold on the economy so that the inflation drops. The question we have to ask ourselves is that really necessary? Is the inflation really at 5%? Well, I would claim no. And you could ask yourself, who am I to claim that? Well, I'm not really nobody to claim that. But there is a nice website here that I would recommend that you visit. It's called trueflation.com. And in this website, they are live, online, getting about 10 million data points of data. They are updating it live every day, every hour, so that we can see what the prices are really in United States and in UK. Today I'll focus on the United States, since the central bank in the United States is what really determines the economic future of the rest of the world as well. The thing is that here you can see that they are saying the inflation year over year is only 2.45%. Now the Fed goal is to have the inflation around 2%, so this is basically telling us that the inflation is almost where it should be and there's no need for any more rate hikes. Now I know that it says here US government reported rate 4%, and you're thinking to yourself, well, that is none of these. No, and that is where it gets extra messy, because there's also an inflation measurement called the PCE, instead of CPI, and the PCE is actually the one that Fed looks at the most, so it gets a bit complicated because there are different ways of calculating them. But basically, Fed and the government, United States, are saying the inflation is way too high, we need some higher interest rates to really pump the inflation down. I agree, it is extremely important to have a low inflation rate. I would rather choose to have a recession, a middle or hard recession, compared to having high inflation rate. A recession is quite normal, and we go through that in different time frames all the time. However, high inflation is really bad, and that is the killer of economies. So what I will say is that normally if the inflation was at 8 or 10 or even 6%, I would completely agree the Fed had to hike the interest rates. But with this live data, we are actually being told here that it is 2.45%, meaning we don't actually need any more rate hikes. Down here, it is a very neat website. You can see that, for instance, the housing, the overall housing here is 3.6%. Now, if you look at the official government numbers, that is somewhere between 6 and 8%. The thing is that housing in the official numbers, that is called shelter, and that accounts for around 1/3 of the core inflation. Meaning that if it is in the official numbers are 8% and it accounts for 1/3 of the entire, it has a 30% weight of the entire inflation number, that means that instead of 5% in core inflation, we actually only have around 2.5%. if we take out shelter. So that is basically what we can see here. Well, you can see the housing, you can see transport and utilities and so on. And of course, they are oscillating up and down, but the overall picture is down. Down here, they are explaining more about how they are doing it, and they have an entire chapter up here just about the mythology, so you can go in and read more about this. But I'm actually looking at this once per week just to see. I think it's quite fascinating to see live where is the inflation, or as it says here, the true inflation. So tomorrow, when you see that we have the inflation rate, of course, if the number is 5, it's great. It's to the downside here. I like this even more, 3.1% here in the normal inflation rate. That will go further down. Now, why can I predict that even without looking at the true inflation here? Well, I can look at it because there's also a number called PPI, and that is called the Producer Price Index. And the Producer Price Index is basically the inflation for producing, for producers, for manufacturers. And what we have seen there is that the last 6 to 8 months, that has dropped massively and has actually gone into the negative many months. So if the PPI is going up, for instance, the producers and manufacturers, it is getting more and more expensive for them to purchase the goods so they can manufacturing some goods for us. So therefore, they will have to raise the prices for us consumers. So the CPI is Consumer Price Index. But when this one starts to drop, the PPI, and it did that sometimes last autumn, I think it was, then we know that there is a lag, because the producers want to say, to make sure that this is actually a steady trend before they start to lower their selling cost to the consumers. So after somewhere between 3 to 6, sometimes 8 months after this, the PPI start dropping, then the producer prices are starting to drop. And that is exactly what we saw here. And right now we are still seeing the PPI dropping, which means that the inflation will keep dropping. And my guess is that we actually might just see the inflation go into the negative, being deflation, which, as I mentioned, is not that good. So use this trueflation here, but of course if this number is higher tomorrow, if that was 5.1 or 5.2, we will see that people will get even more certain that Fed will hike the rates. You can look at other dates as well in the future here and see how the market is pricing this in. I've also put it all in a trading view template here where I can see all the yields. So I can see here that we have the 10-year yield and the 30-year yield, and up here we have the 1 year and 1 month and so on. And then you can see as the Fed has hiked their interest rate, the market yields also has gone up. So if the inflation tomorrow is getting lower, 5% or maybe even lower, then we will also see the market yields starting to drop, and that means a lot for the companies that has a lot of debt. Right now we can see that every time the market is getting more and more certain that we'll see some interest hikes, we also see that many tech companies drop a bit, many of the smaller companies are dropping, many of the so-called zombie companies, that are companies that can basically only earn enough to pay the interest on their debt and nothing else. And now with the hikes in the interest rate, they cannot even pay the interest on the debt. So every time we see a higher inflation, we should expect some higher interest rates, which will send the more vulnerable companies down in price and the more solid companies up in price. On the other hand, if we see a lot lower CPI here, we could expect the Fed to maybe only hike once for the rest of the year here, which means that all of the smaller companies, more indebted companies, will have a bit of a better time, and we will see the indices like Nasdaq and many of the smaller tech companies go up in price. So that is why it is important to have a fairly good idea of where is inflation, what direction has inflation, what do we think Fed will do, because that can determine which sectors and which stocks you should be looking at. I hope this was motivational, inspirational, educational for you, and please leave a message if you have any questions. Remember to like and subscribe, and I'll talk to you again shortly. Take care of yourself and your money out there. Bye for now.